You all hang in there now because we're going to have a nice coffee break. In fact, why don't you stand up now if you want. Just stretch for a little bit and then we'll sit down and we're going to introduce this fine gentleman. And I do need your attention. Okay, thank you. Well, I want to introduce this speaker, and I have the privilege of doing it, so I'm happy to do it, and I want your full attention. Ben Gisin has proven to be probably the very best at due diligence. In his work, he's been absolutely relentless in obtaining references to secure the broad spectrum of information in regard to whatever subject he's involved with. His background is interesting for our benefit because he's been a chief credit officer working for top banks and has approved thousands of loans. He's also helped to get legislation approved for agriculture purposes. And he and his wife Susan, who's with us here, have written this magazine, Touch the Soil. And so whatever time we have for questions that you don't find enough time, he's going to be around for a while yet, tomorrow I'm sure yet. And so we'll catch up with him. But we're going to give him his due today. And with your attention, this is Ben Gisin.
Can everybody hear me, I guess? Can we get that, flip that switch there on the front? Thank you. The mechanics of money, a danger to civilization, comes from many, many years of being in the banking business and also afterwards doing private consulting for farmers and ranchers who had borrowed too much money from banks. Most of our clients generally borrowed between $1 million and $15 million. And what I thought would be a consulting business when I left the banking business, and I was the chief agricultural approval officer for a top 10 ag bank, have been on thousands of farming operations, been involved in billions of dollars of credit extensions, is that America's best was going to fight with their bankers, and we went with them. We got on the other side of the desk. And it's through this fight and all of the processes that took place that as we begin to look deeper into the processes, yes, the mechanics of money, modern mechanics of money, is really a danger to our civilization. Oops. In all of us exists a desire to be part of a kinder, more cooperative and connected civilization. I can't tell you how much that is in the heart of America's farmers who believe when they're in trouble that there is a kind or someone that understands or concerns that will reach out there and help them through their troubles. Instead of having a kinder and a more responsive system, they get kicked in the teeth and they don't understand. Many times we had farm families that were sitting in our offices. The husband would say, Ben, I don't know what we're going to do here. Can you just take over the whole thing and deal with these bankers? I don't even know how I'm going to keep my health. The woman is crying. And then ultimately the whole thing gets smattered to smithereens. Well, we've done a tremendous fight anyway. So, yet we find ourselves snared in a monetary system that ignores the human spirit, ignores the physical survival of most of Earth's inhabitants, and makes us antagonistic competitors. Money's inability to serve humankind is increasingly taking center stage. Why is our means of exchange so costly, hard to acquire, and economically threatening? Why is the time of millions of people of such little cash and bank deposit value? While we like to use the term money, what we're going to deal with here is basically the processes themselves. And so while we may have ideas what money is, what money may not be, let's just look what's actually in practice today and disassemble that. Why are many stranded on the side of the road, unable to help themselves? It is well enough that the people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning. And I can tell you, when you get into the heart of the beast and you're fighting as hard as you can, you begin to understand the system. Do banking mechanisms, the sole source of money, malfunction as a means of exchange, resulting in human abuse and poverty? We will look at a number of things here. The mechanics of Federal Reserve notes, the creation of cash, the mechanics of banking, the creation of bank deposits, and then one that's barely touched upon is secondary lending, the debt monster that can't make money work, and we'll go into that in a little more detail. And then cultural migration away from the bank money. The less it works, the more creative people are getting, and I think this room is evidence of that. Mechanics of Federal Reserve notes, and I'll use these terms interchangeably, they're Fed notes, cash, and currency. A popular misconception is that our currency is not backed by anything. I hear that all the time. Well, there's nothing behind our currency. Big mistake. Much to our detriment, currency is backed by the interest-bearing debt of the public. And this is just kind of how it works. Down below, obligating the public, the Treasury captures our energy. And when the Federal Reserve first started at the turn of the centuries in the early 1900s, that's exactly what the Treasury did. The Treasury captured our energy in the form of U.S. Treasury bills, the national debt, and loaned them, actually gave them to the Federal Reserve as a basis for printing their currency. And so that's the way it works today. The Treasury obligates us. Our energy is embedded in the national debt as Treasury bills. They don't issue Treasury bills anymore. This is the closest I could get as a savings bond. It's still part of the national debt, and it's embodied here in a document. And then these Treasury bills are handed to the Fed as a way to back its currency. So our debt, which is our energy, is handed on a platter over the Federal Reserve as a basis for our money. So currency gets its value solely from the public's bondage that says we owe it. That's the way it works today. And separated from the public that created it, currency now requires a police state to protect it from the public. Kind of a strange turn of events. And ultimately there's a thread here of why we're entering into a police state, not totally disconnected from this event. Just a few minutes on the technicalities. A lot of people talk about the Fed and they never see the Fed balance sheet, so we're just going to show you how it works. This is the asset side of the Federal Reserve Bank, and you can see, you would think cash would be on this side, wouldn't you? Don't you put cash on your asset side of your balance sheet? Well, yeah, on the Federal Reserves, the primary asset is U.S. Treasury securities, $744 billion. Have a gold certificate account. Somebody must have some gold for them. And a little special drawing rights. That's an account receivable through the IMF. Then on the liability side, the Federal Reserve, item number 3, has $758 billion in Federal Reserve notes outstanding. So now we have the question on the bottom here. I says, when is cash not cash? So here's when is cash not cash. Item number 1 is the amount of bills that the Federal Reserve has received from the United States Treasury, from the engraving department when they print it. But they haven't yet put it into the banking system, so it's not earning interest, it's not debt. And so that portion, item number 2, $148 billion, is sitting in the vaults of Federal Reserve banks, and it's cash, looks like cash, but it's not yet cash. And the crowning accounting entry that turns cash into debt, and the cash that we get, is when your vault teller at your local bank decides it needs some cash. And what she does is she debits their Federal Reserve, their reserve account at the Federal Reserve Bank, and credits cash. So basically the Federal Reserve owes the bank this deposit that the bank has with it, and they take that deposit and buy cash with it. So your vault teller buys cash, and when it goes to this vault teller's general ledger and that statement, that is when cash becomes debt bearing and we pay interest on it. So here's how the Federal Reserve collateralizes its notes between the two red lines. It uses its $11 billion in gold. $2.2 billion in special drawing rights and $745 billion in the national debt to collateralize it, and we pay interest on it. We paid last year about $29 billion on that $758 billion in Federal Reserve notes. And on the income side, the largest income that the Federal Reserve gets to operate on is the $28,958 billion, and it's clipping its coupons on the national debt and taking that money in to operate on. On the expense side, it does all of its expenses, pays its stockholders, transfers something to its surplus, and then $21 billion it pays back to the Treasury. Interestingly, the Fed calls this interest on Federal Reserve notes. So are Federal Reserve notes traveling America's means of exchange highway? And we've talked about the black holes in our economy where we have a lot of supply and a lot of demand, but there's nothing to facilitate it, so there's no means of exchange, no process there for those who want to work, who have energy to put into the economy, to receive that energy and work from someone else. On December 31st, 2005, there was $750 billion in Federal Reserve notes in circulation. Estimates are that 70% of this currency circulates overseas. Wow, you mean we just went through all this expense and 70% of the money that we want to use as a means of exchange is already out of the country? Yep. So that brings our use down to $227 billion. Fed estimates that of that, 20% of it is hoarded domestically. So that brings us down to $182 billion. And that doesn't include the cash that's in bank vaults that's not doing anything that we pay for it. Hey, where's it as a means of exchange? If you were to borrow at your bank a credit line and draw off that credit line and cash a check, and let's say your credit line is at 12%, and with this amount of money in circulation and the $29 billion that we paid for interest on the currency that we don't get use of, that interest is around 15 to 16%, so you're paying 28 to 30% if you have a credit line, borrow, and convert it to cash to use that cash. Pretty inefficient, pretty expensive. So Federal Reserve notes are costly. They have a limited domestic availability, are a target for theft, and they would rather earn interest than serve as a means of exchange. Particularly on the heels of our last speaker, we need a process of exchange. We need a means of exchange. Money's not sure what it's doing. Abe Lincoln, we've all seen this. Abe proposes that the federal government create and spend all of the currency and credits that we need for both the government and the consumers. This is what Abe wants to do, different from the slides that we had earlier. Money is authorized by the government without debt, and supposedly the public has easier access to government than the Federal Reserve if things are not going well. That's probably subject to debate. Mechanics of banking. So we've talked just a little bit about the processes of the Federal Reserve, and when people talk about money, this is the process that's in place today, and this is the process that we are using. What is banking? Here we have a river through which the current flows, and there's a bank on either side, and so the banks direct the flow of the current. But in our livelihoods, we have banks on all sides of us, and they direct the flow of the currency, and thus direct the flow of human energy. The Federal Reserve notes are used in only 20% of purchases. This means the public and its businesses must go into debt at banks for additional means of exchange. Is this a mistake? Is this on purpose, that in fact we're not creating enough money to begin with, and so that we're thrown into the den of somebody else? I don't think it's a mistake. Starting off with the banking, thus our national circulating medium is at the mercy of loan transactions of banks, which lend out money, but promises to supply money they do not possess. I have a little joke here. When I was still in the lending business, I had this customer that came in, and for whatever reasons, his application didn't cash flow and it didn't meet bank policy, and I was the lucky dog that got to tell him that we're not going to do the loan for him. So he was upset and he left. And I kind of forgot about it, and I'd seen him around town, and every time I saw him, I just kind of, geez, there's that guy again. He's just looking at me like I'm a bad dude. So one day, he got brave enough, and he came into the office, and he sat down at my desk, and he says, Ben, I figured out how to take my money with me when I die. And I go, really? And at the time, I was working for a big bank called Rainier Bank. It was, I think, the 6th or 7th largest ag bank in the nation up in Washington. And I said, well, how do you take your money with you when you die? And he says, well, what I'm going to do is I'm going to deposit it in Rainier Bank because you got branches all over hell. This is a cute sign. I was driving down in Utah and came across this sign that said, Centennial Bank, millions to lend, commercial, construction, and mortgage. So does Centennial Bank have the money to lend? And the Federal Deposit Insurance Corporation on their website, the call reports that these banks send in, they have to send in all of their financial information so you can look up their balance sheet, which I did. I'm going to share with you here. So Centennial Bank has cash in due of $2 million, but due from other banks, and cash what it has in its vault, and cash that it needs to operate on. So with $2 million, and most of it necessary for operations, does Centennial Bank have $2 million to lend? It has some securities, but you know, $32 million in securities doesn't go long or far to protect $152.9 billion in deposits. Now this is the critical thing to understand about banking. This liability where it says deposits, there is nothing in those accounts, only bank credit. The bank's credit that it will supply money at some point. But as our previous economist said, the bank doesn't have any money. So anyway, this is an important aspect of banking. When when you owe the bank money, you sign a note and usually pledge the collateral. But when the bank owes you, it signs nothing and pledges nothing. And is that an accident? I don't think so. And this has been a real mistrust in the past of consumers with bankers, is that, hey, I've got an entry in an account, and when they give you your new account information, they've got all the restrictions of when you can't take it out. So the bank solves this problem. Since we have nothing to give, and we're not going to pledge the assets that we have, by golly, that's not, you just keep your hands off that. They decided we'll have Federal Deposit Insurance Corporation and the FDIC that insures your deposit. Not the bank, the FDIC. And there's roughly $1.25 in FDIC funds for every $100 in insured deposits. That's how that works. I like this picture. This reminds me of banking at its best. A few years back, when I was still in the active banking, we had a Russian come, and actually we had a number of people from Eastern Europe come and learn the capitalistic system of banking. And so this Russian banker spent a day with me, and we went through the process, basically underwriting, risk assessment, and all of that. And when we went to lunch, he says, you know, Ben, why don't you tell me about capitalism and how this whole banking thing works? And some of the other senior officers of the bank were with me, and we were kind of trudging down to lunch. And I said, let's see, do you understand the word chaos? And the Russian banker looked at me, chaos? And I said, yeah, you know, nuts, crazy, upside down. He says, yeah, I understand that. And I said, well, when you understand that, you'll understand capitalism. Okay, we're going to go through a little scenario here. This is actually from a consultant client that we had, and it was a smaller one. The dollar numbers are pretty much the same, and I'm not going to bore you with all the gory details. This person went through. Hell would be a great place to be compared to what this person and Susan and I went through with him. But we'll start the story out. He was in a stress situation, and we got involved, and I had really misgivings about getting involved in this particular deal because I didn't see it working. And it was, anyway, what happened is we started negotiating with the bank. The bank, I believe, because of my credibility and the fact that we were involved, and the bank knows when we're involved, we're all going to play fair. Everybody's hands are on the top of the table. We're not going to steal money from you. And that's how we got a lot of our jobs. So the bank, I believe, trusting in me, and this happened a number of times throughout, agreed to grant the loan because we were there to provide stability. So anyway, Joe Farmer went into the bank, and this is real important to the order of things, how they work. The first thing he did was he signed a note and he pledged collateral. He pledged everything he owned, his real estate, his home, all his machinery equipment, and his crops. So anyway, the bank has these documents from the borrower and says, you know, we now have an asset. But what are we going to do with him? I mean, my gosh, he's wanting something. So they didn't have the $1.4 million in the vault, and the FDIC insurance that insures other deposits will never, ever allow a bank to go to somebody else's account and take it out and move it over because, hey, they're insuring that deposit and you're not going to make it, put it at further risk. So the bank says, hey, I know what we'll do. We'll just put a number in there and it says we owe him. And that's what they did. And our laws will protect us, which they do. So really, there is no such thing as money, only bank credit. And that's what we have to understand is why our economy is going through such contortions, both domestically and globally, is that if it doesn't fit within the bank credit model, it just isn't there. The way it works is when a bank says, I owe you, that IOU kind of moves around in violate depending on the amount that the check is written for, amongst other banks. So when Joe Farmer writes a bank to another person and they deposit it, then that IOU transfers from the first bank to the IOU, the second bank. There was really never any money that passed, it's just the IOU passed. I'm not going to get into the details. If you want to talk to me afterwards, it's done through their reserve accounts at the Federal Reserve, and we can go into that detail. So basically, by virtue of its birth from a loan, the deposit must come back with interest to pay the loan. Joe is accruing interest, and in order to pay the interest, he needs deposits created from someone else's loan who will be shorted. As things got progressively worse, Joe couldn't pay. It took him longer to collect the money, and Joe came up with some money, $950,000, but he still owed the $1.4 million. We're probably 2 years. The loan is stressed. There's been legal fees. There's been late fees and additional interest, and Joe just can't get it all back. There's just been too many other competitors out there, and you just can't get it back. So Joe sells his farm to developers to pay the bank loan. Now, Joe didn't realize that this is what he did. Joe raised the food to feed the banker. Joe also, by virtue of giving assets to the banker, was a primary force in creating the deposits that the banker used to buy the food. Now, figure that one out. Joe not only raised the food, but Joe created the money that the banker used to buy his food. By virtue of paying the loan with interest, he shorted someone else. And he was no match for powerful interest who played hardball to buy his produce at below production costs. I'll just make one statement here. Agriculture cannot stand up to incorporated wealth. Those interests are so powerful, they interpret what the supply and demand is, and by the time he gets done, he is just beat. And it happens over and over again. I was just telling someone earlier, just to give you perspective, in Idaho, all of you are aware of potatoes from Idaho. In the mid-'80s, there were 2,000 potato growers in Idaho. Today, there's less than 350. Oh, the bottom one. This is a cute one. Because Joe paid his taxes, and understand, remember when we went back there at the Federal Reserve level, we pay interest on the cash that we use? And the bank has cash in its vault that we're not using, but it accrues interest, and by virtue of paying his taxes, Joe paid a portion of the cost of the bank's inventory of money. Isn't that great? Every bank deposit is the blood, sweat, and tears of a borrower, placing his personal and economic well-being at risk, so the larger economy has a temporary means of exchange. I think that's the thing about farm borrowers and everybody else. It's not only do they have to go to work and produce something that we can constructively use in our economy or our consumption, but they're at risk for the money that everybody uses to buy what they produced. Quite a statement. As people borrow, deposits enter the economy. As they pay back, deposits disappear from the economy, i.e. the temporary nature of money. And it's not tied to production, which it should be, like the gentleman said. This was cute. After Joe moved off the farm, he was counseled by an ag economist from the State Land Grant College. He went up there he got a small scholarship and went up to school. And the ag economist, actually there was a number of them there, said Joe did his fellow consumers a favor by giving up his inefficient operation. Now look what happens to the economist. As more farmers like Joe left the community, his rural community experienced a severe decline. Without the tax base to support higher education, the ag economist lost his job. Imagine that. He was promoting policies that resulted in the elimination of his own employment. It happens pretty frequently. So the morals of Joe's story with bank credit as money is simply this: we can't afford ourselves. That's becoming real evident. And there is an insufficient process in which Joe Farmer can exchange the value of his efforts and resources with a larger economy to survive. There's another thing with bank credit that's real dangerous, and we're playing a very, very dangerous game, and that is because when you're talking about loans and debt, one of the primary components of that is to take collateral. So developing the land generates far more loans and pumps more deposits into a means of exchange starved economy. I mean, a farmer, if he gets a good price on his potatoes, may put a couple of $1,000s of borrowed money into the economy. But hey, if you got $1 million real estate development, look how much better that is for the economy. So the decision is unanimous. Pave the land that raises food in order to generate enough deposits to buy food. And that is a dangerous game because we are literally, America's agricultural prowess, and I'm not going to go into the details, is just tanking. America farms on average 3 to 4.5 million acres less each year, and in addition to all of the, just a whole lot of other issues. So, and here's how, this is another imbalance. Real estate related debt is growing by over $1 trillion a year. 70% of all bank loans are secured by some form of real estate. The single largest bond market issues are bonds secured by home mortgages pushing $6 trillion. And in other real estate development, in terms of municipal bonds that does sewers and schools and whatnot, it's another $2+ trillion. And when you add the growth of these three debt markets, you're pushing over $1 trillion a year into real estate development. Heaven forbid the poor farm that's in the way. So the banking preference for real estate collateral means our money creation process destabilizes America's food security by paving the farmland. Here's another side effect that we have there. The lending frenzy creates homes faster than the public can finance roads, bridges, and infrastructures, literally getting the American economy stuck in traffic. These roads are a kind of an interesting perspective. In the last 20 years, the number of registered drivers has gone up almost 40%. And the number of miles traveled on the highway has gone up by 75%, and the actual lane miles added. That doesn't mean fixing lanes that are already there. Just the number of lane miles added is less than 5%. So what we have is a complete destabilization of the physical portion of the United States, in which we're just, the finance industry over here doing personal real estate is totally out of balance with the government and municipalities trying to maintain infrastructure. Our bullish debt frenzy is turning America into chaos. So now we're going to tie it all together, how the bank money flows through the bank and the Federal Reserve. Mr. Doe goes to the bank, signs a note, pledges collateral, and says to the bank, I owe you. The bank makes a credit entry in Mr. Doe's account and says, we owe you. Mr. Doe writes a check for cash. The teller gives him a Federal Reserve notes and says, the Fed owes you. Mr. Doe goes to the Fed, says, you owe me. The Fed replaces the note with a Treasury bill and says, the Treasury owes you. Mr. Doe goes to the Treasury and says, you owe me. The Treasury says, the Treasury bill Mr. Doe has is the national debt, and that he, Mr. Doe, owes it to himself. So here's what Mr. Doe figures out, and I think this is what we all need to understand, is that Mr. Doe realizes there's no such thing as money. There's only circular accounting that keeps track of who owes who, that has him liable at both ends. And that is the way it works. Anyway, Mr. Doe tries to explain the process to his neighbors, who have all decided he's crazy. So here another good quote. The process by which banks create money is so simple that the mind is repelled. While Fed notes and deposits are supposed to be a means of exchange, I mean, that's what I hear all the time. I ask people what money is. Well, it's a means of exchange. And so I thought, well, let's go in and see, is money really a means of exchange, or what is its primary function? What is it primarily created for? Money flips in and out of corruption, hides from the economy and savings accounts, makes unreasonable investment demands, and is servant to concentrations of wealth. Not hardly what I would call a constructive means of exchange. The question is, and why we're all assembled, is whether we can establish a process of exchange that justly connects all of humanity. Fed notes and bank deposits are not going to do that. They're not going to rise to the occasion. Can you see a banker rising to the occasion to save us? I can't. Secondary lending. There's been a lot of confusion about debt and money, and this is really the big monster. Because we talked earlier and we said, well, is it a mistake that the Fed doesn't create enough circulating medium, that we're now captive to the banks? And we have to ask the question here. Are we really banks not creating enough means of exchange that we're captive to something else? And yes, the answer is true. We are captive to something else, and that's called secondary lending. That is the relending of the bank deposits, the IOUs, the bank credit, the relending of bank credit, and that is huge. Matter of fact, it takes 5 times more debt to relend these bank deposits throughout the economy to get some semblance of an economy that we have than it does debt that it takes to create the money. And we'll go through the pieces here. We're going to go in 5-year segments. So back in 1985, the gross domestic product was 4.2 trillion, and there was the 4 large, what I would call debt markets. And the red one is the bond market. That's like home secured mortgages. That's like if a big corporation wants to borrow municipal bonds. There's other kinds of bonds that are backed by now with credit cards and other things. And then there's the national debt. Now, part of that national debt is that amount of national debt that backs the Federal Reserve currency. So part of the money creation process is in this blue one here. And then there is the bank debt. We've talked about that. That's primarily a creation of deposits. And then we have thrifts and credit unions, which don't create money, but again are just another thing like the bond market, relending the deposits that we thought were supposed to be the means of exchange. We go forward 5 years to 1990. The gross domestic product is 5.8 trillion, but the debt, these 4 debt markets have grown to 11.8 trillion. We go, wow, now this is efficient. For every $1 trillion the gross domestic product grew, these debt markets grew by 2.7 trillion. What's wrong with this number? Let's fast forward another 5 years. We get to 1995, and from 90 to 95, for every $1 trillion in gross domestic product growth, these debt markets grew by 2.9 trillion. So we're kind of from an old banking school. You look at this and say, well, you know, this economic enterprise that we're thinking about financing is throwing off more debt than it is creating economic activity which it needs to pay itself. It doesn't qualify for bank credit, but yet, by golly, we're using bank credit. It's an invalidation of the entire system. By 2000, we are now, for the last 5 years, between 95 and 2000, it $3.4 trillion of debt, which grew out of, for every $1 trillion of economic activity. And the last 4 years, look at this, last 5 years, $4.4 trillion. I've thought about this a lot, and it's hard to say why this does it. Certainly you can do the interest factor. I mean, you can add the interest factor here, but these numbers are growing faster than the interest. And even if you added the interest onto the growth of the gross domestic product, it's still growing faster than that. The bond market, which is the red one, I've read they've made statements in the past where they boldly admit that the debt in the bond market is growing faster than the real economy. And this is a real concern, because what this does and what this means is that we don't understand interest rates correctly. When you have twice as much debt operating in an economy, relatively speaking, than you did 15 or 20 years ago, that means a 6% interest rate today, in terms of its ability to extract cash from the poor who are in debt, is twice as effective as it was 20 years ago. So a 6% rate today could be as punishing, or is as punishing, as a 12% interest rate was 20 years ago. And we don't understand that. And it's particularly of concern, considering that in this incredible debt buildup, we've had rates increase 17 times in the last 2 years, and you ask yourself, why was that? And we have all kinds of excuses for inflation and whatnot, but the bottom line is this: there is a receiving end on the other side of every dollar of debt here. And this probably represents some of the largest transference of wealth from the have-nots to those who are on the receiving end. In short, when you look at this entire monetary process, from the Federal Reserve, which has debt attached to it and an interest bill, through the banking system, which has debt and interest attached, through the secondary lending, which all has debt and an interest attached, you understand real simply what the entire thought process is behind bank credit. It is to extract wealth. And whatever little it can afford as a means of exchange or a process of exchange is what we get. And it's not enough to go around. Here it is in a graph. It just shows you the growth of the domestic product and the growth of the GDP. This is an interesting one. We took the same and we graphed it against the growth of the population. And so this last 20 years, the population has grown 25%. The attendant debt has grown 387%, and bankruptcies have grown 403%. We all know what people who file bankruptcy are. They're dirtbags. They're just good for nothing. Isn't that right? But look at the correlation. Do we think there's a correlation here between this growth and the rate of bankruptcy? There's a very direct correlation. With all due disrespect, banking activities are a mathematical and economic absurdity. Banks are dinosaurs. I like this picture of bankers. Thrashing in the debt-ridden world they created. Bank-created money has failed and is increasingly failing as a means of exchange. According to UNICEF, 30,000 children die each day due to poverty. Is it conceivable that injustices are engineered into the banking process? The bank hath the benefit of interest on all monies which it creates out of nothing. William Patterson, founder of the Bank of England. Is that an injustice? So when you get the big picture of the whole financial structure with the banking at its base, the human expression must fit, or more appropriately, must be crammed into, must be crammed down to fit within the lending and collection operations of the world's financial institutions. The unmet needs are literally unfathomable. I just don't know that you can even measure what part of the human family can't fit within this sardine can of cornucopia of trash. So, the great free nations of the world must take control of our money problems if these problems are not to take control of us. Very well said. I think it gets to the point. And American Society of Civil Engineers estimates that America's infrastructure deficit is at 1.6 trillion. So What do we as a nation think about that? Some schools of thought say we don't compete aggressively enough. Wow, that's an idea. Maybe we're not competing aggressively enough. I think these schools lack education in monetary matters. Over 37 million Americans are food insecure and humiliated by having to rely on food banks as a permanent source of groceries. Just down the street here, about 8 blocks this morning, I had an interview for a story in our magazine by Second Harvest. Second Harvest is America's largest food bank. They confirmed to me and affirmed to me that they collect food from large corporate donors and other contributions. They serve over 50,000 charitable agencies throughout the United States whose sole goal is to feed food to people almost on a permanent basis now. So we have some schools that say we should kick each other when one of us is down. That's a good idea. I think these schools, whoever came up with that idea, lack education and mercy. Over 2 million bankruptcies were filed in the United States in 2005. There are the Enron schools of thought. Maybe we got to practice piracy. Hey, let's just go rob each other. That might be an idea. Again, I think these schools lack education and ethics. 47 million Americans have no health insurance, and estimates are that 85 million are underinsured. Here's an idea. There are those schools of thought who say we should fight each other. I think these schools lack education and diplomacy. It's not just these schools, maybe politics as well. The National Coalition for the Homeless estimates there are over 3 million homeless persons in the United States. And here's what we should do. There are those schools of thought that say the fault lies in people's inability to act like a rabid animal, for crying out loud. I think these schools don't know the difference between humans or animals. The point being, we can have a chuckle about these mascots, is that teaching aggression as a way to increase the efficiency of bank money only increases the speed at which we tear apart our economic fabric. And as we have concentrations of wealth, as we have concentrations of wealth, just like the farmers that we fought through and all the battles that we went through, they just can't stand up to these powerful concentrations of wealth, and it just further disintegrates our economic fabric. And right now we are really feeling that, America, with our loss of farmland and other productivity, jobs moving overseas. Incidentally, while we're talking about this, Abraham Lincoln was asked when they were building the railroads, they said, Abe, we can build the railroads in the United States, but we have to produce the steel and build it here. Or should we buy the steel from overseas and bring it in and build our railways? And Abe Lincoln says, well, if you ask me, it's real simple. If we buy the rail and the steel from overseas, we get the railroads, but we have to part with our money. But if we build it here in America, we keep the roads and our money. Isn't that something? So, is the world starting to migrate away from money? Are these abuses causing a little bit larger structural movements away from money? Thousands of volunteers and donations support the feeding of 37 million food-secure Americans. People are discovering an efficiency that bank money can never duplicate. This is not a little thing. When I talked to Second Harvest this morning, they informed me that they have in their network of food banks 1 million volunteers that are on average donating 53 hours a year. And as these people get together and cooperate, these food banks are concerned about the economic problems that we're in. And the more they get together and the more they cooperate, the more creative our culture is going to become. This is an interesting story here. Fulcrum Farm is a little CSA in California, and they 20 acres, and they have a few cows, and they raise some specialty grains. They have a little orchard, and they're surviving. And when we talked to them, they said that 1/3 of our economic activity is with trades. Now, if they had the cash, certainly they would do that. But this was the crowning statement. They said that trades provide far more value than cash purchases. And you ask yourself, why would this be? Well, think about it for just a minute. You don't have gratuitous salaries going out the door to to huge annual payments to chief executive officers when you're buying a product from Walmart, for example, heaven forbid. You don't have the Wall Street lenders in there taking their share of the interest out of it. And you don't have something else that literally is threatening our culture, and that is obsolescence that's engineered into the products. Through engineered obsolescence, we are filling our landfills, our cars are just trash, and we've got to go back and mine the world each year to rebuild this stuff. And if we don't come to terms with obsolescence and depreciation, it will bury us with this monetary system. Oh, we even have some communities are let's do local currencies. This is interesting. China is looking to trade with Africa by building infrastructure in exchange for oil. We're the bankers in this process, they're out. And the more they exclude us, potentially, the more the human race is going to exclude them. Even up in Washington, here in the United States, this barter fair gets together every year. There's 15,000 people, and it used to be called the Okanagan Barter Fair, and they now changed the name to the Family Fair so they could stay out of trouble with the IRS. When 15,000 people get together just to yuck it up and trade. What's going on in South America is really, we've seen some films about that. These are Argentinians, and what they're doing is they're bashing the walls of these banks that collapsed in 2001. And they're saying down there, and they're trying to warn the whole world, hey, think about this. It's coming to you. It's come to us, and it's going to come and visit with you. And looking at how quickly these debt aggregates are growing, we should probably at least listen. Out of that came a whole new movement in Argentina where there are some 200 plus factories that were taken over by the workers after the bankers left and the factories folded that are now producing. And it's not unionization and it's not banking. It's, hey, we're the economy and we're going to run the economy as economy belongs to the people. Imagine that. The economy belongs to the people. The American Monetary Institute's concept of an exchange without debt and its entry into the economy without ruthless competition is the beginning of human enlightenment. In the forced marriage to bank credit as the sole source of an exchange medium, human suffering spills totally off the charts and is gaining ground in first world countries. It's time to pursue a process of exchange that connects the most remote corners of humanity. When people connect and cooperate, an unseen creative power is with them. The power comes from people acting as if we're one. Thank you, ladies and gentlemen. Whoops.
Any questions?
Is this still working? Bob.
First, let me say, way to go, Ben.
Thank you, Bob. Let's go get him.
One of your earliest slides, you were showing the bank balance sheet, and you said that when Joe Farmer pledges his collateral, the bank enters it as its asset.
Yes.
And you've got the column on the other side where it's a liability. Is that what they mean by double entry bookkeeping?
I think so, and I think what makes the whole thing complicated is this. As a consumer, when we fill out a balance sheet for a bank, we list cash as an asset. And when it gets to the bank itself will list cash as an asset. But when it gets to the Federal Reserve level, it's a liability. And that really is the bottom line. Our cash really is a tremendous liability to our culture, and we can't think of cutting through all these different levels of accounting to get to the end, and that's what's confusing.
Yeah, so they're really entering the same information twice.
Well, not exactly, because the first information is a loan accruing interest, and the second information is just a deposit. And if it's in a checking account, it's not accruing interest. If it's in a savings account, it is accruing interest, but it's not acting as a means of exchange.
But it sounds like they're keeping two sets of books, just like the old goldsmiths did.
Bob, that's exactly what there is. There is nothing there. There is just bank credit, and a bank credit is just like, is your credit good? Yes, your credit is good. Is the bank credit's good? Yes, its credit is good, and that's all there is. Trust me, I've been involved in billions and billions of dollars of credit extensions and never made a loan.
You made a statement about teaching aggression, and I'd like you to elaborate a little bit on how you think we teach aggression. Also, as I see it, competition is part of what causes what you might be calling aggression. Business people tend to compete for the consumer's business. I don't know how you can change that fact without affecting, almost directly dictating what a consumer has to purchase and how he has to live. And another question is, it seems to me that the money in circulation today is very high. People pay high rent, willing to pay high rates of interest. They don't save very much. They eat out often as families, and this signals to me that there's a lot of money in circulation, and it seems to be a little bit of a contradiction as to the nature of our problems that we have. Do we or do we not have a money problem?
Well, it seems like there's some money in circulation.
First question was on how aggression is taught.
I think that's a fundamental concept in economics that we're philosophically unable to deal with because we think we need to bash each other's heads in in order to keep the economy going. And, you know, that's I think Professor Guido's back there, his concept a little bit of having money be attached to production is probably a little bit closer. The problem that we have with competition is that it ultimately results in concentrations of capital. And while we all agree in the process of competition, we disagree by having it concentrated in capital. So on the one hand, we like to compete, and on the other hand, we don't like the results of its ultimately what ends up happening. And so how do you stop concentrations of capital? What we need is a kind of money or a kinds of exchange that doesn't end up in concentrations. And perhaps that might be better served by some form of cooperation. I might make a statement about conspiracy theories, and particularly as it relates to this competition. I have people oftentimes ask me, Ben, do you believe in conspiracies? Do we really have conspiracies? And I said, well, conspiracies, it's not just that we have a conspiracy here or there. Because of our monetary systems, conspiracies define our economic landscape. And if we don't have a conspiracy, there are such conflicts of interest that are on their way up that as soon as one conspiracy goes away, there's another conflict of interest that will evolve into a conspiracy. I mean, think about the health insurance or health. Do doctors have an interest to have a healthy society? I don't think so. I mean, do weapons manufacturers have an interest in having peace? I don't think so. We have so many conflicts of interest with bank credit because it's primarily a process of extracting wealth. And the next question was?
Is there too much money circulating, I think was his next question.
When you take an average of too much money circulating, that's a real problem because then you ignore the concentrations of wealth on the one side and the extreme poverty on the other side. Did you know there's just 10 years ago there was only probably a handful of these payday loan places. Today there's over 20,000 and they charge sometimes 300 to 500%, and 30% of payday loans goes to buy food. And so while it appears that there may be money in inflation, it's not in a huge segment of the economy. There may be a segment of the economy that it's at, but there's a segment of the economy where it's not. Yes, sir.
As a professor of finance, former banker, I can say that your lecture is much more thorough on banking than anything that I was able to hear in college.
Thank you, sir.
I only found one mistake in your presentation.
Well, tell me and I'll change it for the next one.
The zip code on your your check for Kansas was a zip code of New York State, not Kansas.
Oh,
And I know you wouldn't want to make that.
it's probably a New York bank.
But there's one point I'd like to add.
Please.
I had an archaeological group, and we've done a study of debts back in Babylonia from 2000 BC to about 500 BC. We found out that about 80% of the debts were not loans. They were, and 80% of the interest paid on these debts were arrears, primarily to the tax collectors, primarily for people who would run into debt to the local bar or beer lady for paydays, business payables. The great majority of interest paid long before there were banks were for bills that were not paid on time, including taxes. So the phenomenon you're describing doesn't really need banks. It goes even back before banks, but you've certainly described the process of banks quite accurately.
Thank you. I might just make one comment to cheer us on. And it has to do with debts, and it comes from my home country of Switzerland. I immigrated from Switzerland when I was a young boy, 6 years old. And the story of Swiss independence began a little over 700 years ago, when in a village not too far from where I was born, William Tell, who was a very powerful and strong, physically mountain man, went into the little town, and there was a stick there with a hat on it that belonged to the tax collector. And the rule was when you walk by the tax collector's hat, you have to bow to the hat. So William Tell with his son just walked by and said, "Phooey, I'm not going to bow to this hat," and went about his business, and he was arrested. And he was brought in front of the tax collector, and the tax collector said, "William Tell, as punishment for disobeying my rule and not bowing to my hat, you're going to have to shoot an apple off your son's head with your crossbow." You've all heard that's part of the story from William Tell. So William Tell was pretty anxious, and if you've ever seen a crossbow, those things are deadly. And he shot, and he hit the apple. But the story goes on. And the tax collector said to William Tell, he said, "William, when you took the arrows out to shoot the apple off your son's head, you took 2 arrows. How come?" And William Tell looked at him and he said, "Well, simple. If the first arrow that I was shooting at my son missed, the second arrow was for your heart, and I wouldn't have missed that one." So the tax collector was upset, and he represented the King of Austria at that time, and William Tell was chained, and they were taking him to Austria. But to get there, they had to go across one of these beautiful Swiss lakes, and a storm came up. And the 2 guards that had him chained in the little rowboat were afraid that it was going to capsize, so they unlocked William Tell so he could help steer the boat. When they got close to shore, William Tell dove in and escaped. Well, a little time later, the tax collector went for a little trip, and he had to go through the place where William Tell lived, and William Tell got him. And I won't explain the details, but then after that, this is what happened. In order to go against the taxes of the King of Austria, the Swiss men got together, and the Swiss people from 3 colonies, they said, "Today, and here moving forward, we are no longer going to pay the tax." So what ensued was a number of battles, and the Swiss many times were outnumbered 20 to 1. And in one of the pivotal battles, the Austrian army, they were very well full of arms. They had good shields, they had strong spears, and the Swiss couldn't get through the shields, and they were being beaten. And they retreated, and one man said, "I have an idea. I'm going to run up to the line, and I'm going to take as many spears as I can get. And I'm going to bring him into me. I will die, but it will create an opening." And so that's exactly what he did. He created the opening. The Swiss went in behind and just kicked the living dog. And for 700 years now, Swiss has been a free democratic republic. And the question to the Swiss is, and this is really for the larger human family, the question never is, how big is the opponent? How big is the battle? The question is the principle right? And if the principle is right, we fight. Thank you.
All right, it's coffee break time, but I just want to quickly add one thing about the economy, and you touched on one of the things about less people having health insurance. Is it true in your city as well as mine? Time after time, store window after store window now is posting signs, so-and-so had this accident, needs help, please donate money, so-and-so is sick. And please don't donate money, you know, so forth. I mean, I have never in my life seen that many posters pleading for help for people who've been sick or hurt. Thank you. Well, let's get something to eat.